Imagine waking up one morning to find your digital assets completely frozen. Not by hackers, not by a forgotten password, but by new laws passed in the dead of night. This isn't some far-off dystopian fantasy. It's a pattern as old as money itself. Throughout history, whenever a crisis hits, governments don't just print new rules, they rewrite the very definition of ownership. Think about it. In smoky back rooms and grand marble halls, leaders gather. They draft secret clauses, hidden deep within thousand-page bills. They sign executive orders with a dramatic flourish, while the rest of the world is glued to sensational headlines and consumed by chaos. Let's travel back to 1933. The Great Depression has America in a chokehold. Banks are failing left and right, and public confidence has shattered into a million pieces. In this climate of fear, President Franklin D. Roosevelt signs Executive Order 6102. This order didn't just ask, it demanded that all Americans surrender their privately held gold. The penalty for refusal? 10 years in prison and a $10,000 fine, enough to buy an entire house back then. Picture the scenes, long lines snaking out of crowded banks. People handing over velvet pouches, wedding rings, coins that had been passed down for generations. Some were openly weeping as they surrendered their family's legacy. Others, more defiant, hid their gold under floorboards, desperately hoping the government's watchful eyes wouldn't find their small treasure. But the eyes were everywhere. Lists were kept, records were checked. The confiscated gold was melted down, recast into bars, and locked away in government vaults. Its former owners were left holding paper dollars, backed not by precious metal, but by a fragile promise. This wasn't a one-time event. Fast forward to 1962. India passes the Gold Control Act, making it illegal to own more than a few ounces of gold. Families who had saved for decades, who saw gold as the ultimate security, watched their life savings vanish into government vaults. Goldsmiths, the backbone of local economies, were ruined overnight. Weddings were stripped of their traditional golden gifts. The law was enforced with raids, arrests, and a pervasive atmosphere of fear. Then came the 1970s, which brought a new wave of currency controls. Countries from the UK to Argentina suddenly limited how much money their citizens could take out of the country. Travelers were searched at airports, bank accounts were frozen without warning, and the world learned a new, chilling term: capital controls. Jump ahead again to 2013. The tiny island nation of Cyprus becomes the epicenter of a new kind of financial shock. Banks suddenly shut their doors, ATMs run dry. Panic grips the island. When the banks finally reopen, depositors discover a brutal, unbelievable truth. A significant portion of their savings has been taken directly from their accounts to bail out the failing banks. They called it a bail-in. The government didn't even need to print new money, it just took yours. And this pattern continues right up to the present day. In 2022, Canada. Protesters fill the streets of Ottawa. In response, the government invokes emergency powers. In a move that shocked the world, it froze not just the bank accounts, but even the crypto wallets linked to the demonstrations. There was no trial, no warning, just a digital lock slammed shut. So why do governments always seem to act in the shadows with such speed and surprise? Because panic is contagious, and the element of surprise is their single greatest weapon. The people who thought their wealth was safe, whether it was gold under the floorboards or money in a secure bank account, learned a hard lesson. The law can change in a heartbeat. Yesterday's security can become today's liability. But as money evolved from physical to digital, the rules of the game, and the risks, changed forever. The world truly changed. In 2009, a mysterious white paper appeared online, signed by a name nobody recognized: Satoshi Nakamoto. Bitcoin was born. This was a radical idea: money without borders, without banks, and without needing anyone's permission. For the very first time in history, it seemed people could hold wealth completely outside the reach of governments and central banks. Or so they thought. At first, Bitcoin was just a curiosity. It was a niche interest for tech-savvy programmers, libertarians, and dreamers. But as its value began to skyrocket, so did the attention it attracted from regulators and lawmakers. By 2017, headlines were screaming about crypto millionaires and devastating losses. Governments, seeing this new form of wealth, took notice. Their old playbook of seize, freeze, and control needed a serious digital update. And they found the perfect tool: blockchain transparency. This is the great paradox of Bitcoin. Every single transaction is recorded on a public ledger, visible to anyone, forever. There's no more hiding gold in the floorboards. Now the entire journey of every coin is open for inspection, by your friends, your enemies, and most importantly, by government agencies. This transparency paved the way for a flood of new laws. You've probably heard the acronyms KYC, which stands for Know Your Customer, and AML, for Anti-Money Laundering. Crypto exchanges were forced to become gatekeepers. They now have to collect your name, your address, and your entire transaction history. Anonymous wallets are being blacklisted, withdrawals are constantly monitored, and if your coins happen to touch a so-called tainted address, even by accident, they can be frozen or refused by exchanges. Some countries are taking it even further. China launched its digital yuan, a central bank digital currency, or CBDC. This isn't like Bitcoin. With a CBDC, every payment, every transfer, every single digital wallet is programmable, traceable, and, if the government deems it necessary, stoppable. They don't need a midnight raid or a court order anymore. All it takes is a few lines of code, and your money is locked. Meanwhile, in the US and Europe, similar proposals are emerging for wallet tracking and real-time surveillance. The EU's MiCA regulation is tightening the screws. The US is debating new, invasive reporting rules for digital assets. Privacy coins are being delisted from major exchanges, and tools used for financial privacy, known as mixers, are being outright banned. The walls are closing in. Remember Canada in 2022? It wasn't just bank accounts. The government also froze Bitcoin wallets associated with the protesters. A digital lock, enforced by law, demonstrated how vulnerable this new asset class could be. So, is your Bitcoin really safe from government eyes? Or is it actually the most traceable money ever invented? What happens when code becomes law? When the rules that govern your money can be changed with a simple software update, a court order, or a new regulation passed in silence. The digital playbook is being written right now, in front of our very eyes. But what really separates these new digital asset grabs from the old ones? The mechanics are different, and the playbook is already in action. In the next section, we'll dive into real-world cases of digital wealth seizure and how this new playbook is unfolding. The digital playbook isn't just theory anymore. It's being tested right now, country by country, crisis by crisis. Let's start in China, 2021. Imagine the world's largest crypto mining operations, humming with activity one day, then going completely dark overnight. A government ban sweeps across the entire nation. Exchanges are shuttered. Billions of dollars in digital assets are frozen, lost, or forced into the shadows. The message from Beijing was crystal clear. It doesn't matter how decentralized your technology is, the state will always control the on-ramps and off-ramps, the exact points where digital money has to meet the real world. Now let's jump to Canada, 2022. A convoy of truckers is protesting in the capital. To support them, donations start pouring in, not just in Canadian dollars, but in Bitcoin. In response, the government invokes emergency powers. Banks are ordered to freeze the accounts of protesters and their supporters. But this time, the freeze didn't stop at traditional bank accounts. It extended to crypto wallets. Major exchanges received lists of flagged wallet addresses, and they complied. Funds were locked, transactions were denied. There was no trial, no court hearing, no warning. Just a digital wall, built in real time, separating people from their money. Meanwhile, across the Atlantic, the European Union is drafting its own set of rules. It's called MiCA, the Markets in Crypto Assets Regulation. It's a sweeping new law that will demand exchanges and wallet providers collect and report massive amounts of user data. As a result, privacy coins are already being delisted. Tools like mixers, which are designed to obscure transaction trails and give users some privacy, are being banned. What's the goal here? Total transparency. And with total transparency comes total control. It's not just Europe. In the United States, lawmakers are debating new rules for digital asset tracking. There are proposals on the table that would require every transaction above a certain threshold to be reported directly to the IRS. Your wallet address could be permanently linked to your real identity. The era of anonymous digital wealth, a core promise of early crypto, is rapidly coming to an end. So, let's ask the critical question. Could your exchange be forced to freeze your assets overnight? The answer is absolutely yes. All it takes is a court order, a new regulation, or a government blacklist. And they're already testing the loopholes to make it even easier. What are these loopholes? First, there's programmable money. Central bank digital currencies, or cbdc's, can be designed to be spent, blocked, or even deleted at the push of a button. Imagine your money having an expiration date, or being restricted to only certain purchases. Second, there are wallet blacklists. These are lists of addresses that exchanges and other services are simply forbidden to interact with. Your wallet could be cut off from the entire financial system without you even knowing why. And third, there's exchange regulation. By controlling every on-ramp and off-ramp, governments can turn them into checkpoints, monitoring every single dollar that moves in or out of the crypto world. The playbook is evolving, the tools are getting sharper, and the next test could come at any moment, without any warning. So, is there anything you can do to protect yourself before it's too late? The answer lies in understanding the contrast, the difference between the old world and the one being built right now. In the old world, seizing your wealth meant sending agents to your door. It meant boots on the ground, gold coins being pried from trembling hands. It meant freezing bank accounts with a physical signature on a piece of paper. The process required a paper trail, physical vaults, and real-world evidence. Now the battlefield is entirely digital. There's no need for a midnight knock on your door. There's no need for armored trucks or sealed vaults. All it takes is a few lines of code, a flagged wallet address, a silent software update, and your assets are locked. They become invisible and untouchable, even to you. In the past, you could try to hide your wealth. You could bury gold under the floorboards, stash cash in a mattress, or flee across a border with your assets. But today, every single transaction leaves a footprint on the blockchain. Every wallet can be traced, flagged, or blacklisted, anywhere in the world, instantly. There's a common myth that says it can't happen again, but the reality is, it's already starting. From the bank bail-ins in Cyprus to the trucker protests in Canada, from China's crypto ban to the EU's new regulations, the playbook is global, and the pace is accelerating. So what's different this time, and what's exactly the same? The tools have changed, evolving from paper to code. But the fundamental nature of power has not. The desire for control remains constant, and that's why the next wealth grab could be even bigger and even faster than anything we've seen before. In the digital age, total control is just a keystroke away. What can you do to stay ahead of the next financial shock? The first step is to understand that history is a warning, written first in gold, then in paper, and now in code. Every era brings a new promise of financial privacy, a new hope that this time your wealth is truly yours and beyond the reach of others. But every era also brings a new tool for control. Think about it. In the 1930s, the US government made it illegal for citizens to own gold, and they tracked and seized it. In the 2000s, with the rise of anti-money laundering laws, cash transactions were heavily monitored, and bank accounts could be frozen with increasing ease. Today, we're seeing Bitcoin wallets being flagged and blacklisted. The pattern is undeniable. When governments feel threatened by economic instability, by social unrest, by new technology, they act. And when they act, privacy is always the first casualty. The lesson here is simple. No system is immune. No technology is untouchable. The only true defense is awareness. It's about knowing the historical cycles, reading the signs of the times, and preparing yourself before the next crisis hits. Will you be ready when the next law is signed? Will you understand the implications for your privacy, your freedom, and your financial future? The answers aren't just in the daily headlines, they're buried in history, waiting for those who are willing to look. Thanks for watching. Subscribe for more hidden financial history and learn how to protect what's yours before the next crisis hits. Join me next time as we uncover the forgotten story of the world's very first digital currency ban. A fascinating tale of innovation, Fear, in a battle for control that is still being fought to this very day. You won't want to miss it.